Hi, good morning, everybody. Green on the screen around the world. The suggestion from the president to buy stock was a little bit of a hint that they were going to go in and make a deal on rare earth. Once there was an agreement on rare earth, they dialed back their respective tariffs, and we are gapped up. I've had a few people ask this morning, how do you deal with this gap up when it's not just in one stock, but basically in everything? And the idea behind it is this isn't technical analysis, right? You apply technical analysis on normal price behavior with the idea that those patterns and the signals will repeat again in the future. When you have unusual price behavior like earnings, economic news, then it's event-driven price action, and it will last until the event-driven price action gets a new event or until that exuberance wears off. So we got the pop. As long as no new negative event information comes in, the pop should stick. And there's 90 days for the current tariff situation to be resolved or to come up with some new agreements. We'll see what happens at that point. It's a pretty quiet Monday on the economic schedule, all things considered. We got some auctions in the front end, so you could use something like IRX. Bank of England in the afternoon. Really, that's it. Once we're through the auctions, anything else that could move the market would be headlines that we can't see coming. So something coming out of the White House, maybe president signing something. I don't see anything listed here. Usually if he's going to sign executive orders, there'll be something listed. Not really seeing anything right now. In 5 minutes, it looks like Scott Bissett is going to be talking. So at U.S. Secretary of Treasury, he can move markets. So we have that right around the table, right? It's just a few minutes away. Volume this morning sitting at 244,000. The average here is between like 50 to 80. And while last week we were back into an average range, we haven't been for a while. So we've been running in the 150s, 250s, and then last week we went back to normal. Now we're back above 200,000 again. A lot of participation in this bump. We are through the call wall at this point. So when we come in tomorrow, we want to see something done with this call wall. Now, at the end of the week, we have OPEX. And the concern is that they don't move this call wall, right? They just go ahead and leave it there because they know they're going to be moving their options later in the week. The other side of that would be that perhaps they go ahead and move it, but they focus on where the new positions would be for next month anyways at the same time. Because it's OPEX, as we get later in the week, we're going to start to see that market maker move signal. Whether or not it's actually a market maker move or not, we won't be able to tell because we're going to be getting flow from people that are rolling and adjusting those front end positions to a farther dated position. We have the 200-day moving average in focus this morning, just above a major options level 58.50. I believe the 200's at like 58.68, something like that. Yeah, there it is. Now, it's not moving averages are just a line in the sand, right? They're not support or resistance, anything like that, but it is a place where we expect to see a reaction in the market. Otherwise, all the other moving averages are underneath us. The 4, 10, and 20 are curled up respectively like a fork, equidistant from each other. It's textbook. And this explosive move does set that low that we were talking about last week as the higher low. Right? I had some doubt and some discussion last week that this might not have been the higher low that we were looking for because it wasn't very deep. We had a much deeper low here. So after that run up with just a little pullback like we got there, there's some concern that maybe that wasn't going to be the higher low. From that range, we could have come down and set a deeper higher low. We did leave a gap behind, yes, but we also have left a gap behind back here, and that one's not filled either, right? So just because we leave a gap behind doesn't mean we've got to go fill it. And the other part of that is that the day isn't done. When we have a gap at the top of a range, a lot of times we have to be concerned with a rug pull, right? That this is like an exhaustion gap, a last hurrah, capitulation gap, or a blow off top kind of signal. If that's the case, then we'll fall back down to our open and we'll leave a long tail behind, very much like back here, where we opened that day and we ran up and it looked really bullish and everything was great. And then we flipped around and ran back down again. Right? So the day isn't done. If we start breaking back down through the levels, then, we play what we got. And the eventual target would be back to where we came from, 56.88-ish, whatever Friday's close is. At this point, there's nothing on the table to suggest that that's what we're going to get. We are through the first ADR. Shouldn't be a surprise. And we pulled back to it to see if we were going to hold it or not. It held. Now we're testing the other ADR. These average daily range, they're a lot like average true range, except that it uses a simple math instead of the complicated weighted front end. The difference would be, think SMA moving averages versus EMA moving averages. The ADR is the simpler formula, right? So our average daily range is just shy of 2%. That's what we make on an average daily move. Well, from where we opened last night in the Globex, if we split that 2% move in half, we can go up 1%, we can go down 1%, and the distance between these two is 2%, right? It's basic market logic. If we move the entire 2% in a single direction, we could make it all the way up there or all the way down there, right? So if we split it in half, we make it to the red lines. If we just move 2% in a single direction, then we make it to the yellow lines. At this point, it's looking like we're going to make it to the yellow lines. Over the last market month, 20 days, that 2% move is what we have been doing on average. So it's not to say that we can't go farther than that. It's just that's what we've been doing on average. So it's just looking at what a typical move is, just another day. This isn't really much of just one of those days. It seems to be a little something extra. So if we get through this yellow line and we continue to drive to the upside, one of the things we're going to be asking is, where's the stopping point? The SPX and the SPY do not have their yellow lines yet, right? Because they won't get them until they open. So at 9:30, we'll just look at Fridays. At 9:30, when we open, no matter where we are, if we're gapped up, whatever, that's when these lines are going to get put on the chart. And the SPX at that point could run to the red line, or it could run to the yellow line from the open, which would be about 1.7% if we run all the way up, right? It's about 100 points higher from where we open. That would be the stopping point. So half of that distance, about 50 points, the full distance, around 100 points. And once the SPX hits those ADRs, then the ES would stop too. I've seen that play out before. Doesn't mean that that's what we're going to get this time. But if we continue to run and we get into the open and the ES breaks above that yellow line and continues to go forward higher, that's what I will be watching, is the SPX, looking for when it hits those ADRs. Otherwise, if we break the red line, come back to where this big candle started, because that's a liquidity gap, 57.66. If we get below that, then target the low of the Globex. And if we get through that, then we'll target the lower red line, 5,700. Level by level, right? On down the line. We have an MDP. The weekly pivot is at 56.70 area. It's down here, lower than Friday's close. The daily floor pivot is within Friday's range, and it's an MDP because we haven't hit that daily pivot yet. It's very likely that we don't hit that pivot today. This won't count for today. It'll count for tomorrow. We do have to worry about how far away from the weekly pivot we are, but I don't think we're far enough at this point for it to be a concern. At 3.5%. Another 1.5% higher, then I'd start to be concerned with how far from the weekly we are. But at this point, it's not the biggest issue to have to contend with. $58.11 cog line lines up with a point of control from the third week of March. Back here. The only thing of interest at this point, and it's underneath this, so on that fade back, we could expect to get hung up a little bit there on the cog line, which we would have expected it anyways because it's a cog line. Lines up pretty close with our own pullback that we've already seen anyways. So likely a 786 area. And we're putting in a pretty good distribution across the high here. Ten-day, 30-minute volume profile with TPO. The TPO and the profile line up really well. Point of control nearly on top of each other. And we still are not into these candles yet. So once we start taking these candles out, it looks like we will see the point of control rise up to this next area. It's 56.88. Beyond that, we don't have a new area, but we've got 2 weeks to build out a new level. So we'll see what we start to put in across these highs. But at this point, the point of control and the TPO's point of control isn't going to offer any insight or value. They are a long ways off. They're inside of that week range, and we would have to get back inside of that range for it to do us any good. We have a new VPOC. $56.78. We jumped over the one from Thursday with this gap up. So we still haven't hit that line, which gives us 3 to the downside if we start to fall back down. One of them in the middle of the gap that we need to close. Kind of an interesting situation. I can't remember the last time we did that. Jump to pivot like that. Either way, the TPO this morning isn't lining up with the volume profile. Which implies we had fewer trades, but more contracts in those trades at these highs up here. The shallow area, if we do happen to fall back down, if we break this structure right here, it's really shallow, and we tend to move through shallow areas really fast. So just kind of keep that in mind. Right. On Friday, we measured last week's range and we compared it to this week's range. But on Friday morning, the range wasn't set yet. So it wouldn't count until after the close. It was just giving us a little insight on what the current week could offer us. Now that we are in the new week in the narrower than last week's range, what that implies is the market is pricing in a slower market move or less of a market move. At first glance, that sounds good, right? Less volatility, less movement, things are slowing down a little bit. But on the other side of that coin is the idea that big events like FOMC, for an example, are volatility suppressing events. And so as we get closer to those events, the markets just kind of tighten up and go sideways and consolidate into that event. Like we did last week, right? Where we went sideways for a whole week. So that's what the market, it looks like that's what the market was pricing in for this week, that the potential for a big event was on the deck, but that they were expecting us to go sideways into that event in a risk off posture, because a lot of times companies don't want to put a lot of money in the market right before a big binary event. And now we got this big breakout instead. We are completely outside of the week's range. So when we think of, how far should we have moved for the entire week? 57.92 cog line, and we're at 58.50. Now, we've made big blowout moves like this before. We can move the entire range plus some. So if we were to make the entire range again, and if we were just to make half the range, $5,900 would be another half. It's well within our grasp to hit that level. And for exuberance, if we, outrun and make the entire move again, 6,000. It's actually a little bit more than that. It's 6011 cog line, but we'll take 6,000 as a nice round number. 5,900 and then 6,000 if the bullish exuberance continues. Simple enough. We are more than 3% above the 10-day moving average, and therein lies the problem. We have to worry about mean reversion at this point. Dot plot, statistics, least squared method, the idea that we've run too far too fast and that we're going to whip back the other direction. Very much like stretching a bungee cord to its fullest extent, right? And then the idea that what happens next, whip back the other way. So we are at the extreme edges. We've gone higher than this before. We can see way back here in June of 2020 when the banks were still buying their way back out of that hole from COVID. And in the bear market of 2022, we were higher than this. The late part of 2022, November. So we are really on the edges of how much farther we could go. We can go a little higher, but that's it. We would expect to stall out at that point. Now, that does not mean that we have to fall back down, but we do need a correction. So it's going to happen through price or through time. Through price, that would be us turning around and falling back down again. Through time would be us stalling out at this new level and going sideways, giving the 10 time to catch up with us. And this is the 10-day, so it won't take very long for the 10-day to normalize. But we are overbought, overextended in the extreme. And I don't like the phrase overbought, oversold. It gives people the wrong idea. But we are extended beyond what we should be. Looking at the 10-week, now this isn't so bad. On this one, we've got plenty of room to move to the upside. We won't start looking at extremes here until we're above 4.5 and closer to 5% above the 10-week. And at this point, we're not even at 3.5 above the 10-week. So we're good here. Which again applies to the idea that we very likely are going to just digest the move that we had and correct through time, that it doesn't owe us a correction in price. We don't need it. If we get it, I'll take it. It'd be a great short back down, but it doesn't owe us that short. Biotech and healthcare combined are not appreciating this news. Gold miners also getting hit hard on this news. And of course the VIX, but I mean, that's a given, right? But healthcare and biotech, and I'd like to say, well, they were doing good. So, now they're going to go down because we're rotating, but they weren't doing good. Biotech was already down 7% before today's half, and it just added to the chaos, right? And healthcare was down about 3% before this morning's move. So they already were negative. This is just extending that negative even farther. When we look at everything else, I mean, literally everything else is up, right? Some things that aren't quite up enough to hit the benchmark would be Bitcoin. It's up, just not quite enough. We need a little bit more out of Bitcoin to hit that benchmark. And real estate is the other one. It's positive, just not by enough. So if we're looking for that rising tide to lift all boats, we have all the boats except staples, real estate, Bitcoin, and the two healthcare and biotech that we had already talked about. Yeah. We have the opportunity today for a high correlation coefficient. I know big words early in the morning. It's the idea that take the S&P 100, right? 100 names. So out of those 100 names, if you have 97, 98, 99 names all moving in the same direction, you have a high correlation. If you have 99 out of 100 names moving to the upside, you don't really need to be proficient at picking stocks, right? We don't really call that a stock picker's market. Anything you throw a dart at is moving, it's probably moving to the upside. So if you were to carry a basket of stocks in a watch list, with every one of those something that you're willing to buy, whether you're buying calls or you're buying stock, then you've got something that I like to call the alpha protocol. The idea would be if you hit 98 or 99 out of 100 names all moving to the upside, you buy everything on your list. This isn't new, and I didn't think it up. It's what the algos do. We can do the same thing, right? They're not the only ones who get to have all the fun. And all you're doing is just buying your basket, and you make up the basket. You decide what's going to be in it. So looking at the S&P 100, having that conversation, we have 70 names out of 100 that are moving to the upside and are up at least 0.5%. That's the benchmark that I use. If we were just looking at names that were up without that qualification of 0.5%, then it'd probably be a lot higher, right? But 70 with this qualifier, that's a high number. That's really bullish. For the NASDAQ, it's 73. 73% of the NASDAQ is up this morning, at least 0.5%. I'd like to say the names that are up matter, but with this high of a correlation coefficient, it doesn't matter. It's the idea of the rising tide, right? It's lifting all boats. It isn't picking and choosing which boats are rising. So if this exuberance continues, when we get into the open and we get into the 80s, 90s, high 90s, you have to decide for yourself when your protocol would kick in. I like 98 or 99 going for the most extreme, but obviously it doesn't need to be that high. On Thinkorswim, if you go to the Visualize tab and the Index Watch, right? You don't want heat map, you want index. You can choose what index you want. So here's the NASDAQ 100. Since the market's not open, there's no numbers here. Once we open, it will populate. Issues are companies. You'll have how many companies are advancing, how many are declining, what the volume is, and what the capital is. If we start to have some divergence, oftentimes it shows up in the capital. Say you'll have more companies going up than down, but more money coming in than going out. That would be some divergence. These pages are detachable, so you can load as many of them as you want. You can have one for the NASDAQ. You can have another one for the S&P. You can have one just for the Mag 7 itself. Whatever watch list you have, you can make one of these for it. And you can shrink them up nice and tight. They don't need to take up a lot of space. Unfortunately, though, you have to rebuild them every morning because every morning they reset. It's the only downside to this. But nice, small little footprint, right? And just stick it somewhere, do another one, another one, another one, load it up. At this point, if you're thinking of shorting this market, you're going to get run over. So wait for a short signal so that you don't get run over. A lot of names failing, bearish flow coming in, bearish headlines coming in, and or just break down through the structure on the way back down, right? We got to break through that level at 58.11 cog line, close this liquidity gap, get through our own Globex low, Friday's close on down the line, right? Level by level by level. Otherwise, we don't have a short signal. We've got a bullish bias across nearly every sector and industry. So take the run. Take the run and go with it. That's what I got for you guys today. Be careful, be safe, watch headlines. They're the other side of this coin today. And I will see you all tomorrow.